Let us look today at OneMain Financial, OMF. So this is a company with a long and proud history, but also a very strong dividend. Yes, we are heading into a recession. Yes, there is risk here, but stick with me. I'm going to show you what we should be looking at in this company and why I think it is attractive today with a good yield. Smash subscribe, learn to grow your wealth with dividends today. So, why OneMain Financial? Now, here in their investor presentation, they have a couple of really important points. One point here is this history in their banking roots of the company. Now, that really creates quite a strong focus on risk management and compliance. And we're going to see the impact of that as well as we go through a few more of these slides. Another thing I really like as well is this way in which they've got a large branch network. Now, you can call me old-fashioned, but I think this is still quite an advantage, and particularly when you consider the type of customers that they can appeal to. Now, it's not just big, it is humongous. So across the USA, it's the 7th largest branch network, and that includes the banks. So we are talking substantial. Not only that, but the people in each branch know their community. So 14 years average branch manager experience. Now, what that means is this is a company that is deeply rooted in and supportive of their local communities in a way in which other companies will not be. Now, one of the things that I really like about OneMain Financial is this focus on customers and a strong customer relationship. So the company itself is engaged with customers, providing a range of different products and a range of different services to meet their ongoing and ever-changing needs. Now, in my mind, that is going to create a strong relationship, and that in turn will create a long-lasting impact on the company's earnings. Now, one of the more recent initiatives as part of this process is the release of the Brightway credit card here. Now, this is good because it's already got a large uptake, and they're expecting to generate quite a bit more growth by 2025 and beyond. Now, what we can see from this as well is OneMain Financial is constantly changing, constantly innovating, and constantly releasing new products and services to build that engagement and drive new sources of revenue. Now, as part of that engagement with customers, the recent acquisition of Trim has enabled them to even go further by actually improving the financial well-being of their clients and customers. And again, this is enabling them to tie up, to integrate, and to really get into the lives of their customers in a much more powerful way. Now, as we do all of this as well, one of the other points is that this is a very digital company. So despite the fact that they've got a very strong branch, old school branch network, this is still a company which is heavily investing in digital, in machine learning, in artificial intelligence. And I suspect an acquisition like Trim is also going to build into that, and it's actually going to generate further greater benefits to the company as they continue to integrate. So, is a recession coming? Well, if it is, OneMain Financial is certainly prepared for it. We're going to see a little bit more about what they've been doing lately, but if we look at this in the last 6 years, they've substantially improved on their overall leverage. They have substantially improved on the liquidity runway, and they've substantially improved on this overall total banking capacity as well. So they're in a much better position than they were 6 years ago. And that is going to enable them to weather some of the storms that they're going to see if there is a severe financial recession coming up. Now, importantly, they have learned from the past, and they've been engaged in the last year in more conservative underwriting, looking for more secured loans, and really beginning to tighten up their ship as they prepare for some of the uncertainty and some of the volatility in the year ahead. Now, what they can say here is that they expect to remain profitable even in a severe recession. And when you think about this, they can compare back to what their portfolio looked like in 2008. And again, I think the key point here is this proactive credit tightening that they've been engaged in terms of looking forward, looking at where they are, and they've been tightening up and becoming more conservative. Now, as I said, hey look, they use a lot of technology. They use a lot of artificial intelligence and proprietary scoring based on this as well. Now, what this means is that they have better, superior management of the risk and management of their underwriting process. Now what this means is when you look at the loss performance and these net charge-offs, they are vastly better than most of these online lenders, and actually quite close to consumer financing banks. So yes, there is some loss and some charge-offs, but it is better than some of their peers that they most closely associate with. So they've been doing a good job, and again, what we've seen over, I think, the last 5 years or so is a strong emphasis on better technology to improve their performance. Now, in my mind, as I said before, that relationship with the customers, that engagement with the customers, that ability to connect with the customers and integrate into their financial lives is what keeps the customers coming back. Now, if you begin to think about this, it means they don't have to spend or invest so much in advertising, so much in marketing, because they've got customers who are coming back to them. They've got customers that are engaging with other services. They've got customers that are paying them more and more money. And that is always, in my mind, a strong formula for success that I also talk about in my operations classes in the university sector that I teach. So this is, for me, a very strong indicator of success for this company and something I'm very keen to engage in as an investor. Now, let's switch over to fast graphs. As we can see here, look, they've got a history. They've got this consistently strong operating earnings growth here that we can see in orange. We can get a sense of this change here with some very strong years, 14%, 53%, 43% growth, 78% growth into 2021, and some muted growth here for several years, but some quite strong expected growth in 2025. As we can see here, prices are quite low relative to the earnings, and we can see this blended PE of under 5. Now, don't get your hopes up, don't get too excited. There are risks, obviously, in investing with this company. Now, if we look here, for example, the S&P credit rating is only a double B, so that's something to keep in mind. S&P sees some risks here as well that we should also be cognizant and careful about. Now, of course, they do have the juicy 11.5% dividend yield, which is going to be quite attractive to us as well, as many of us focus on that yield. Now, how do the analysts do in terms of forecasting this company? Well, it's fairly mixed bag. It's got a short history here, so I think we can write off some of this history, like 2020 has an outsized impact here with the miss. In the 2-year history, switching over in the more recent years, the analysts have been doing a fairly good job, and so I think we can take this short history with the analysts is pretty reasonable. So the analysts are doing a pretty good job of estimating companies' earnings, and the company seems to be doing a good job of providing analysts with good, reasonable estimates and updates. What does this mean then in terms of potential performance? Now, if we switch this to the normal expected price to earnings multiple of about 6 times, as we've seen over the last 5 years, I'm going to take this through to the end of the 2024 financial year. We're talking about potentially a 64% rate of return in total, which is about 28% per year. Now, there's a couple of points to note there as well. A big part of that is going to be this dividend yield. There's also a weakening of the analysts' estimates, and we're going to get into that as well. As the financial and economic situation's deteriorated, obviously that has an impact on the company. We've seen the company believes that they're going to remain profitable, but it still puts pressure on the earnings, and it's still going to have a downward impact, therefore, on the share prices. So that's something to keep in mind. Now, switching over to Finbox, it suggests that analysts have a price target from between 36 on the low side to 60 on the high side, an average of 47, representing some substantial upside potential there. Now, when we look at some of these financial models here, these would suggest a fair price, fair value of about $37 to $42, with an average value from these models of about $40. Now, if you look at that, it suggests that we're 17% undervalued. Now, this is a company then that could be fairly undervalued. It's a company with a very strong dividend yield. So what else do we need to think about? As a final point, just turning over to ticker terminal, looking at the mean analyst targets. So this is from about October with an average target of about $73, and that is down to the average target, as we saw, of about $47 today. Now we can see the big decreases here in the analyst price targets, particularly in the middle of 2022, as we began to see the economic conditions begin to deteriorate, and as we began to see the impact of the higher interest rates from the Fed kicking in and really changing our perspective and outlook on the economy. So what this means is there could be some downwards pressure. This is definitely an investment where you would have to take, I think, a smaller position in your portfolio. It does have some risk. It's a smaller company. It's got a lower credit rating, but it does have these juicy yields. It seems to be slightly undervalued, and it has the potential to continue to grow. And I do like the fundamentals of the business. As I said, I think they're doing a lot of the right things and things I really like to see in a company. This is a company where I do have a small position, and I will be increasing that position size in the coming months. So look, stick around with me if you want to hear more about great dividend investment opportunities.